Welcome to Markets Now. I'm Michelle Rourke with Oliver Slope Blue Line Futures. A down day in the grains on Friday, mixed in cattle higher in the hogs. And Oliver, let's start off talking about the grain trade. Not the best way to finish out the week in the grains and the corn market. Man, we just hit resistance. And so how much of it was profit taking versus maybe even some farmer selling?
I think there was probably a healthy mix of profit taking and farmer selling. Corn has had a nice move higher from those contract lows. We've rallied 10, 11% from those contract lows to the recent highs. We got, the friendly news that the bulls needed to see, but we just couldn't get out above technical resistance. And that was outlined by the October 2nd high, 452 and a quarter. We got within a penny of that following the WASDE report and just ran out of buyers. And the fact that we couldn't extend above that, I think probably just triggered some sell orders. And we retrace in the back half of the week. With that said, I don't know that it's super concerning from a technical standpoint. I think we just retraced the breakdown point from the start of the week. So that's healthy. Looking into the end of the year and beyond, I still think producers are going to want to use these rallies that we get as opportunities to layer in some downside protection, especially when you're looking at measures of volatility. Volatility is at its lowest level since 2019, 2020. So layering in some protection with some put options is probably a good way to go to at least establish a little bit of a floor and potentially keep that upside open in case we do get out above resistance and we do continue to get friendly news that propels this market even higher into the new year.
All right, what would that friendly news be? Does it have to be a problem in South America or demand, or what do you think will be the trigger?
I think demand has been a nice tailwind here as of late. We would like to see that continue. This week's export sales kind of put a damper on that, and potentially that's why we saw some weakness at the end of this week as well. This week's export sales report, 945,000 metric tons. That was down 45% from last week and 32% from the 4-week average. And over the last several months, it seems like Mexico's really been at the top of the list. Well, Colombia was the top of the list this week. So the fact that Mexico maybe backed off a little bit is a caution flag. But if Mexico steps back in and we see other countries step back in as well, potentially that's what gives us a retest of those highs. And then I think if we want to really make a meaningful move out above there, we're probably going to need some hiccups in South America to get us there. There are parts of Argentina that have been dry, and looking at some of the medium-term forecasts 2 to 4 weeks out, potentially that dryness persists, and that's what could potentially get us up there. So right now into the end of the year, a lot of it's kind of hinging on what's going on in South America.
And what about soybeans? Did we see profit taking there on Friday as well? Because we've gotten up into the upper end of our trading range there and can't seem to get through resistance either.
It's wax on, wax off in the soybean market. It's up a dime, down a dime. And when you zoom out over the last, 3-4 weeks, it seems like we really haven't gone anywhere. Call it $9.90 to $10. I think building up energy and kind of waiting for new news to give us new direction. I kind of think that we could potentially see a breakout to the upside. But again, as mentioned with corn, I think potentially that takes a hiccup in South American weather to do that. But until then, it's just kind of wait and see until we get that new news. One thing I would also note, corn has been outperforming soybeans and wheat here as of late. I've been talking with a lot of traders at the Board of Trade, and over the last several months, there's been a trade on that's been long 2 corn, short 1 bean. And that's performed really well, but it's reached a level that's a little bit overextended. So I wouldn't be surprised to see maybe corn settle down in terms of performance, and I think potentially beans and maybe even wheat could play catch up a little bit if they get some friendly tailwinds into the end of the year.
Yeah, I wondered if maybe we got a little bit of corn soybean spread unwinding here. Maybe even yesterday it looked like that might have been the case. But soybeans, we talk about being range bound, but you say you believe that we have this big South American crop and as well the tariff concerns kind of already priced in.
Yeah, it's definitely a contrarian take. We've been talking about tariff talk, big balance sheet, potential bumper crop out of South America. These are not new headlines this week. They weren't new headlines last week. We've been talking about these headlines for several months now. So I think a lot of that is baked into the cake. I think there maybe is still some risk premium baked in there, but I also think there's an underpriced risk that some of those maybe retreat. What if South America gets a hiccup? What if we start to see demand pick up? What if China comes back to the table with the new administration in the U.S. and wants to make a deal. I think those are all things that are a little bit underpriced. And as mentioned with corn, when you're looking at volatility at multi-year lows, I think there's an opportunity to try to capitalize on that if any of those were to come to light.
What about the wheat market? Did it just follow corn and soybeans, or was that technical?
Wheat's been trying its best to carve out an intermediate term low from December 4th near 540, where we made new contract lows, reverse, and finished that day positive. But over the last 2 to 3 sessions, we've seen that market retreat. I think if we can hold 540 to 545, I think we have the potential to really make a solid low. Breaking close to the low there, I think, would be concerning. But yeah, I think a stronger U.S. dollar and some pressure in corn and beans certainly didn't help wheat to round out the week.
Absolutely. So cattle market, live cattle going higher, feeders going the opposite direction here today. Let's deal with those separately. Live cattle pricing in higher cash and cutouts, but we did kind of have a reversal yesterday. Did we negate that with today's action?
Yeah, yesterday's reversal, we came out of the gates very, very strong. We've had a little bit of a breakout in the cash market this week, which propelled futures quite a bit higher. I think we rallied as much as almost $7 this week from the low to high. So I think a lot of that is being priced into the cake. We are at our highest level since March 22nd. The top end of the range going back then in March was, I think, 194.85. So we're out at some pretty lofty levels. That's not to say we can't continue higher. It'll be interesting to see if cash can continue to lead this market. But I'm a little bit concerned at these upper levels that there is a lot of downside risk, especially when you look at the Commitment of Traders report. Last week's report had funds long about 122,000 futures and options contracts, which is the largest from 2019. Which 2019 was a record 155,000. So we're not at a record, but very lofty levels. And anytime you get, funds net long over 110,000 contracts, I start to see some caution flags go up. If the fundamentals start to soften up, or even just stagnate, you could see some liquidation. And with the end of the year too, some profit taking wouldn't be out of the question for some of these funds.
Yeah, end of the year profit taking is a really good point that you make. Now, in the feeders, we saw that market down today. Obviously, the market is anticipating the reopening of the Mexican border to feeder cattle. How much downside risk do you think we have in that market as we open that border?
Well, it's the same type of thing. When you look at fund positioning, everyone seems to be on the same side of the boat there. For feeder cattle, funds are a lot less active. They're only long about 19,000 futures and options contracts, which doesn't sound like a lot. But when you look at historical positioning for funds, that is a lot. It's only 3,000 away from the record net long, which was set back in 2012. So I think, as with live cattle, you get any of these fundamental tailwinds become stagnant, you could start to see the market retrace a little bit. And I think one of those headlines would be the South America or the U.S.-Mexico border reopening. That's what really gave us that extra jolt higher here last month. And if that, gets taken away, I think there's some downside risk there. And then just technically 261 to 263 has just been a huge hurdle for the market to get out above, not just here recently, but, looking back to May, June, and July as well. It's been a very, very stout resistance.
And the hogs up here today on a Friday, but we've basically consolidated now under the contract highs. The funds, what are they still record long? Do they keep defending that position or not, Oliver?
The fund length has been the theme of the last few weeks in the livestock markets, and it's really caught the attention of a lot of people in lean hogs specifically. Their old record net long position was just about 98,000 contracts from 2013. Last week's report had them long about 133,000 contracts. So a lot of people on the same side of the boat. We started to see some volatility pick up here this week with some intraday pullbacks. That was quickly bought up. So we haven't broken down yet, but I do think there is some downside risk. $84 in that February contract has been really good, solid support here this week. It was the lows from Tuesday. We tested and held that the last 3 sessions. It also represents the 50-day moving average. I think if we break and close below that, you could start to see the long liquidation snowball into weaker prices.
Okay, thanks so much, Oliver Slope with Blue Line Futures. That is Markets Now.